Ever feel like the stock market is a casino where only the house wins? What if you could peek behind the curtain and trade right alongside the pros? This isn't about getting lucky. It's about smart, strategic moves that can turn the tables in your favor. Imagine knowing exactly where to buy and sell, not just guessing based on gut feelings, but using proven strategies that tap into the heart of the market's supply and demand. Today, you're going to learn how to spot those key zones where big money moves, understand why these spots can make or break your trades, and most importantly, how to capitalize on them effectively. Think about it. How powerful would it be to identify potential turning points in the market before they happen? We'll dive into not just finding these zones, but also deciphering which ones are gold mines and which are landmines. Ready to stop following the crowd and start setting your own trading paths? We're tearing down the complex world of Forex and stock trading into simple, actionable steps that you can use right now to refine your trades, boost your confidence, and start seeing real results. And the best part, you'll learn how to combine these insights with market trends and psychological factors to multiply your effectiveness. Whether you're trading from your kitchen table or a downtown office, these strategies are about to change your trading game. What is supply and demand? So what exactly are supply and demand zones? Simply put, these zones are areas on the price chart where significant buying or selling pressure occurs, often due to the activities of large financial institutions, also known as smart money. When we talk about supply, we refer to areas where sellers are likely to enter the market in large numbers, driving the price down. Conversely, demand refers to areas where buyers are expected to step in heavily, pushing the price up. The key to successful trading is to identify these zones and align your trades with the movements of these big players. By doing so, you can ride the waves of their market influence, maximizing your profits and minimizing your risks. Now let's talk about market dynamics. Markets are constantly moving between periods of balance and imbalance. A balanced market, also known as consolidation, is where the price moves sideways with no clear direction. This happens when buyers and sellers are evenly matched. On the other hand, an imbalanced market occurs when there is a strong movement in one direction, indicating that one side, either buyers or sellers, is significantly stronger. This creates momentum, leading to the formation of supply and demand zones. Understanding these dynamics is crucial because it helps you anticipate where the price is likely to move next. Let's look at some examples to solidify these concepts. Imagine a price chart where the market is moving sideways with small overlapping candlesticks. This is an example of a balanced market or consolidation phase. Here, the price isn't making any significant upward or downward moves. It's essentially taking a break, waiting for more information before deciding on its next direction. Now, let's contrast this with an imbalanced market. Picture a chart where after a period of sideways movement, you suddenly see a series of large candlesticks moving in one direction. This indicates a strong momentum move. For instance, if you see a series of large green candlesticks, it means there's strong buying pressure. This is where a demand zone is forming. Similarly, a series of large red candlesticks indicates strong selling pressure, signaling the formation of a supply zone. Here's a real-life example. Look at this chart of the EUR-USD currency pair. You can see that the price was moving sideways for a while, indicating a period of consolidation. This is a balanced market. But notice what happens next. A series of large green candlesticks appears, showing a strong upward movement. This marks the formation of a demand zone. The smart money large financial institutions have started buying heavily, pushing the price up. On the other hand, when you see the price making a strong downward move with large red candlesticks, a supply zone is being created. This is where these big players are selling off their positions, causing the price to drop. Understanding these visual cues on the chart is crucial for identifying supply and demand zones. By recognizing these patterns, you can align your trades with the actions of smart money, greatly improving your chances of success. In summary, supply and demand zones are areas on the chart where significant buying or selling occurs. Recognizing these zones allows you to trade in alignment with the big players, enhancing your trading strategy. Markets move between periods of balance, consolidation, and imbalance momentum, and understanding this dynamic helps you anticipate market movements. Identifying and drawing supply and demand zones. Having established what supply and demand are in trading, let's explore how to identify and draw these critical zones on a price chart. This skill is pivotal for implementing successful supply and demand trading strategies. The process begins by scouting for momentum candles on your chart. These are not your average candles. They are large, conspicuous, and signify robust buying or selling activity. For a zone to qualify as either supply or demand, you need to identify at least 3 consecutive momentum candles moving in one direction. This pattern indicates a strong presence of either buyers in the case of rising green candles, which would point to a demand zone, or sellers when you spot descending red candles, suggesting a supply zone. Once you've spotted these momentum candles, the next task is to determine the origin, the starting point of this forceful move. This origin candle is crucial because it marks the initial reaction point where the significant buying or selling began. With the origin identified, your next step is to draw the zone. Using your trading platform's rectangle tool, draw a box encompassing the high and low of the origin candle. Extend this rectangle to the right side of your chart. This extended box now represents the potential zone where future price action could react, offering you potential trading opportunities. Let's ground this with an example. Consider we're looking at the USD JPY currency pair. You notice a sequence of 3 substantial green candles moving upwards, a strong indication of buying momentum. The origin of this movement is a smaller red candle that precedes these green candles. You would draw your rectangle from the high to the low of this red candle and extend this zone outwards. This area now marked is your demand zone, and you'd watch this area closely for when the price returns to consider a buying opportunity. Conversely, for a supply zone example, let's turn to the GBPP USD chart. Here you find 3 large red candles heading downward. The last green candle before this drop is your origin. You draw your rectangle from the high to the low of this green candle, creating a supply zone. When the price revisits this zone, it might be an excellent opportunity to sell, anticipating the price will drop following the pattern set by the smart money's previous selling activity. Understanding the types of zones can further refine your trading. Supply reversal zone, rally-based drop. This zone forms after the price makes a significant upward move, stalls or consolidates, and then begins a sharp decline. This pattern suggests sellers overpowering buyers, creating a strong selling area. Demand reversal zone, drop-based rally. This pattern emerges when the price drops significantly, finds a base where it consolidates, and then shoots upward, indicating strong buying pressure overcoming selling. Both patterns provide strategic entry points depending on their context within the broader market trends and the strength of their formation signals. Spotting these accurately requires practice, but mastering this can significantly enhance your trading precision. To truly cement your ability to identify and draw these zones, let's practice with real-time charts. Open your trading platform, choose a currency pair or a stock you are interested in, and apply these steps. Look for the momentum, identify the origin, and draw the zone. Practice on various time frames and instruments to build your proficiency. Entry and exit points. Now that you're equipped with the skills to identify and draw supply and demand zones, it's crucial to understand how to determine the best entry and exit points. This will significantly enhance your trading efficiency by ensuring that you're not just entering trades at good locations, but also at optimal times. When it comes to entering a trade, patience is your best ally. Once a supply or demand zone has been identified, the common mistake is to jump right in. However, successful trading demands that you wait for the price to return to these identified zones. This is where the market has previously shown a strong response, and by waiting, you align yourself with the momentum carried by the smart money. For example, if we have identified a demand zone based on previous buying momentum, we don't immediately place a buy order. Instead, we wait for the price to retrace back to this zone. Entering a trade as soon as the price touches the zone can be tempting, but it's crucial to wait for confirmation that the zone will hold. This confirmation could be in the form of a price rejection at the zone or a reversal pattern, which signals that the buying pressure remains strong. Let's consider a practical scenario. You are watching the EUR/USD and it enters a demand zone you've marked based on previous buying surges. As the price touches this zone, instead of rushing to buy, observe the reaction. If you see a bullish pin bar or a series of accumulating bullish candles, this can serve as your confirmation to enter a buy trade. Setting a proper exit strategy is equally important. A well-defined stop loss should always be in place to limit potential losses. For a trade entered at a demand zone, set your stop loss just below the zone. This placement ensures that if the zone doesn't hold and the price continues to fall, your losses are cut short before they escalate. For taking profits, identify the next significant opposite zone as your initial target. If you're buying from a demand zone, look upwards on the chart for the next clear supply zone. Setting your take profit here maximizes your chances of capturing a good stretch of the price move while the market momentum is in your favor. Additionally, managing your trade as it progresses is crucial. If the price moves favorably, consider adjusting your stop loss to break even or using a trailing stop to lock in profits as the price moves further into profit. This dynamic approach to managing exits not only secures your gains, but also keeps you in the trade for potential extended runs. So let's recap the key points. Wait for the price to return to the identified supply or demand zone before considering entry. Look for confirmation signals within the zone to validate your entry. This could be through candlestick patterns or other technical indicators. Set a stop loss just outside the zone to protect against the trade moving against you. Identify the next significant zone in the opposite direction for taking profits, ensuring you capture the most from market movements. Manage the trade actively by adjusting stop losses or using trailing stops to secure profits as the trade progresses. By following these strategies, you'll enhance your trading discipline and increase the probability of successful trades. High quality versus low quality zones. Now, understanding how to distinguish between high quality and low quality supply and demand zones is essential for refining your trading decisions. By focusing on high quality zones, you can increase your chances of successful trades and reduce risk. Let's delve into how to identify these zones and what differentiates them. High quality zones are characterized by distinct features that indicate strong market reactions and sustained momentum. These zones typically form with clear and impulsive moves away from them, showing significant buying or selling pressure that suggests the presence of smart money or large institutional players. The candles within these zones are usually large, showing little wick, which implies that the market moved quickly away from the area, leaving little doubt about the direction. For instance, imagine you're looking at a chart and you see a sharp price drop that forms a supply zone. The drop consists of several large full-bodied red candles with minimal wicks. This is a strong indication that sellers were aggressive and in control, pushing the price down swiftly. When price returns to this zone, the likelihood of it acting as resistance and pushing the price down again is high because the original sentiment of strong selling pressure might still influence trader behavior. On the other hand, low quality zones often exhibit uncertainty and lack decisive movement. These zones might have formed through gradual price moves with candles that have large wicks or mixed green and red candles, indicating a struggle between buyers and sellers with no clear winner. Engaging trades in these areas can be risky as the market has not shown strong evidence of a supply or demand imbalance. Let's consider a practical application. If you're analyzing a potential demand zone and the zone was created by a slow upward crawl with candles that have large upper and lower wicks, this signals hesitation and a lack of strong buying momentum. Trading in such a zone could result in a false breakout or a weak reaction when the price returns to this level. The quality of a zone can also be assessed by the volume of trades that occurred during its formation. High volume during the formation of a zone confirms that a significant number of transactions took place, adding credibility to the strength of the zone. Most trading platforms provide volume indicators that can help you visualize this aspect. Furthermore, the context in which these zones form is also crucial. A high-quality demand zone forming after a long downtrend might not be as reliable as one that forms in an uptrend. The overall market trend can influence the effectiveness of these zones. In bullish markets, demand zones tend to hold more reliably, while in bearish markets, supply zones may offer better trading opportunities. In practice, you should plot these zones on your charts, annotate them with notes on their quality, and only consider trading those that meet the highest standards of clarity and confluence with other indicators. Why some zones work and others don't. After learning how to distinguish between high quality and low quality zones, it's crucial to understand why some zones work effectively as trading areas while others fail. This knowledge can significantly enhance your ability to make informed trading decisions, helping you to avoid potential traps and capitalize on the most promising opportunity. First, let's delve into the concept of market structure, which plays a pivotal role in the effectiveness of supply and demand zones. Market structure refers to the broader patterns and trends that are present in the market. These can include long-term uptrends, downtrends, or range-bound conditions. A supply or demand zone that aligns with the prevailing market structure is more likely to hold and produce a favorable outcome. For example, consider a demand zone that forms during a strong uptrend. This zone is more likely to be effective because it is supported by the overall bullish sentiment in the market. Traders are generally optimistic, and there's a prevailing willingness to buy dips, which reinforces the strength of the demand zone. Conversely, a demand zone that forms during a downtrend might not be as effective because the general market sentiment is bearish and buyers may be less inclined to step in strongly. Another critical factor is the historical significance of the zone. Zones that have been tested multiple times and have consistently held are more reliable. Each time a zone holds, it adds to the collective market memory, reinforcing the area as a significant barrier or support level. Traders often watch these levels closely, waiting to act when the price returns to these historically significant points. Let's discuss timing and frequency of tests. Zones that are frequently tested within a short period may become weakened over time. Each test can diminish the orders located at the zone, gradually reducing its effectiveness. For instance, a supply zone that repels price several times over a few days might start to fail on subsequent tests as the selling pressure exhausts and sellers at that level are depleted. Volume also plays a crucial role in validating the strength of a zone. High volume during the formation of a zone indicates strong participation and commitment from traders at those levels. If a zone is formed with significant volume, it suggests a decisive and collective action by the market participants, making it more likely to hold in the future. Conversely, a zone formed with low volume might lack the necessary commitment to withstand price tests. To apply these concepts, consider using tools like volume profiles or looking at trading activity levels to gauge the strength of a zone. For example, if you're analyzing a potential supply zone and notice that the drop was accompanied by high volume, this provides additional validation that the zone has substantial market interest and may act as a strong resistance in the future. Moreover, the psychological aspects of trading also influence zone effectiveness. Key psychological price levels, such as round numbers or historically significant prices, can strengthen the impact of supply and demand zones. Traders often place orders around these psychological levels, which can enhance the reactions when these levels are tested. High win rate, supply, and demand trading strategy. Armed with an understanding of how to identify high-quality zones and why some zones work better than others, it's time to put this knowledge into practice with a high win rate supply and demand trading strategy. Here, I will guide you through a strategy designed to leverage the concepts we've discussed, maximizing your trading effectiveness. Identifying strong zones. The foundation of a successful supply and demand trading strategy starts with identifying strong zones. Use the criteria we discussed in previous sections to distinguish high-quality zones. Look for zones with significant price moves away from them, supported by high volume and preferably aligning with the overall market trend. Remember, a zone's first test is often the most potent, so prioritize zones that haven't been tested since their formation. For example, if you spot a demand zone on the EUR/USD USD chart that was formed during a strong upward move and hasn't been tested since, mark this zone as a high potential area for a long trade. Confirmatory signals. Once you have identified a promising zone, wait for the price to return to this area. Do not jump in as soon as the price reaches the zone. Instead, look for confirmatory signals that indicate the zone is likely to hold. These signals can include bullish candlestick patterns such as hammers or engulfing candles for demand zones, or bearish patterns like shooting stars or engulfing candles for supply zones. Additionally, you can use other technical indicators for further confirmation. For example, an oversold reading on the relative strength index, RSI, when the price hits a demand zone can reinforce a potential buy signal. Entry and risk management. Enter the trade once you have confirmation that the zone is holding. Set your entry point at or near the confirmatory signal within the zone, ensuring you are maximizing the potential risk to reward ratio. Always set a stop loss to manage your risk. The stop loss should be placed just outside the zone where the invalidation of the zone is clear. For a demand zone, place your stop loss just below the zone. For a supply zone, place it just above. For example, if you enter a buy trade based on a bullish engulfing pattern in a demand zone, place your stop loss below the lowest point of the engulfing pattern, ensuring it's outside the demand zone. Setting profit targets. Your profit target should be set towards the next clear supply or demand zone in the direction of your trade. By aiming for the next zone, you utilize the natural price movement expected as the price moves from one zone to another. This strategy maximizes your potential gain while maintaining a solid risk-reward ratio. Additionally, consider using trailing stops once your trade moves into profit. This method allows you to lock in gains while giving the trade room to grow further, protecting your profits if the market reverses suddenly. Review and adjust. Regularly review the effectiveness of your trades. Analyze whether the zones you're trading are performing as expected and refine your criteria based on real-time feedback. If you notice that certain types of zones consistently fail, adjust your strategy to either avoid these or require stronger confirmation before trading them. This high win rate supply and demand trading strategy integrates all the elements we've covered, from identifying strong zones, waiting for confirmatory signals, managing risk with precise stop losses, to strategically setting profit targets. By applying this structured approach, you can significantly enhance your trading performance, making disciplined, informed decisions based on clear criteria. Combining supply and demand with market structure. Now it's time to put this knowledge into practice with a high win rate supply and demand trading strategy. This final section will guide you through a comprehensive strategy designed to leverage the concepts we've discussed, maximizing your trading effectiveness. Identifying strong zones. The foundation of a successful supply and demand trading strategy starts with identifying strong zones. Use the criteria we discussed in previous sections to distinguish high-quality zones. Look for zones with significant price moves away from them, supported by high volume and preferably aligning with the overall market trend. Remember, a zone's first test is often the most potent, so prioritize zones that haven't been tested since their formation. For example, if you spot a demand zone on the EUR/USD chart that was formed during a strong upward move and hasn't been tested since, mark this zone as a high potential area for a long trade. Confirmatory signals. Once you have identified a promising zone, wait for the price to return to this area. Do not jump in as soon as the price reaches the zone. Instead, look for confirmatory signals that indicate the zone is likely to hold. These signals can include bullish candlestick patterns such as hammers or engulfing candles for demand zones, or bearish patterns like shooting stars or engulfing candles for supply zones. Additionally, you can use other technical indicators for further confirmation. For example, an oversold reading on the relative strength index, RSI, when the price hits a demand zone can reinforce a potential buy signal. Entry and risk management. Enter the trade once you have confirmation that the zone is holding. Set your entry point at or near the confirmatory signal within the zone, ensuring you are maximizing the potential risk to reward ratio. Always set a stop loss to manage your risk. The stop loss should be placed just outside the zone where the invalidation of the zone is clear. For a demand zone, place your stop loss just below the zone. For a supply zone, place it just above. For example, if you enter a buy trade based on a bullish engulfing pattern in a demand zone, place your stop loss below the lowest point of the engulfing pattern, ensuring it's outside the demand zone. Setting profit targets. Your profit target should be set towards the next clear supply or demand zone in the direction of your trade. By aiming for the next zone, you utilize the natural price movement expected as the price moves from one zone to another. This strategy maximizes your potential gain while maintaining a solid risk-reward ratio. Additionally, consider using trailing stops once your trade moves into profit. This method allows you to lock in gains while giving the trade room to grow further, protecting your profits if the market reverses suddenly. Review and adjust. Regularly review the effectiveness of your trades. Analyze whether the zones you're trading are performing as expected, and refine your criteria based on real-time feedback. If you notice that certain types of zones consistently fail, adjust your strategy to either avoid these or require stronger confirmation before trading them. This high win rate supply and demand trading strategy integrates all the elements we've covered, from identifying strong zones, waiting for confirmatory signals, managing risk with precise stop losses, to strategically setting profit targets. By applying this structured approach, you can significantly enhance your trading performance, making disciplined, informed decisions based on clear criteria. And this is how you will be able to master supply and demand trading Forex. However, if what you really want is to turn trading into your main source of income in this year and start earning anywhere from $1,000 to $1,500 per week, all this starting from zero with no knowledge or experience and dedicating only 2 to 3 hours a day, I have a proposal for you. Go to the link in the description of this video and click on it. There you'll find a website where I have a training that explains to you how you can do it in less than 10 minutes and how I can help you achieve these results in 3 months or less. Also, how to be the next student who sends me a screenshot of these results, which are the exact results that the Swing Trading Lab students are getting. Results of money that they are making on a daily basis, and you will be the next one. So click on the link in the description and watch the video fully. I'll see you inside.